Sir, good afternoon.
Good afternoon.
Sir, you are live in the session today, and we welcome you for today's session on professional insights on tax audit. For the participants, we would like to introduce CMA Ajit Shivadas. He is a practicing cost accountant with he's actually a cost accountant with over an experience of 15 years. We welcome you for the session, sir. Over to you for the session.
Thanks a lot, madam. Very good afternoon, one and all. Thank you, TRD, giving me this opportunity to interact with the professional colleagues on the topic Professional Insights Tax Audit 2025. It's quite a relevant time for discussing this topic, Tax Audit 2025. We as CFOs, we as finance managers, we as tax advisors, we as tax consultants, definitely yes, would be in a point wherein we are finalizing the organization, company's books of accounts, getting it ready for the purpose of filing its income tax return, as well as for making it applicable for tax audit purposes also. So in that context, what are all the things that we have to understand? What are all the practicalities that we should be aware of with regarding to this tax audit we would be discussing for the day? And at the outset itself, definitely yes, we know this year's income tax returns, even the individual or the non-tax audit income tax returns has been extended, which was about to be ended up with this month, last 31st of July. The due date under section 139(1) has been extended to 15th of September 2025. So 45 days extension has been given. And definitely yes, as far as non-tax audit associates are concerned, their income tax ITR form, only two forms, ITR 1 as well as ITR 4, was introduced or was published or was notified. Now, maybe 1 week back, ITR 2 as well as ITR 3 has been notified. So, a lot of works are going behind the returns for AOP BOI partnership firm in form ITR 5 is yet to get notified. Then those ITRs which is applicable for private limited companies in form of ITR 6 is also not been notified, along with the NGNPO, what you call trust return in ITR 7. So only 4 forms has been notified, ranging from ITR 1 to ITR 4 till date. So we are eagerly waiting for this remaining forms in form of ITR 5, ITR 6 as well as 7. So what are all the changes which is been proposed yet to come? But definitely yes, this year's income tax return is going to be tricky for 2 reasons. The department is trying to curb all those tax evasions via various multiple checks, multiple points of verifications, etc. All those refunds that we are going to claim definitely would be rechecked, and the evidences would be required to be submitted in order to get those refunds. And there was an advisory from the income tax department itself saying that the refunds are not going to get sanctioned that much easier. That was way till the last financial year or last assessment year sort of procedure. So definitely yes, this year is going to be one of the year wherein more and more sort of involvement from the income tax department side regarding this double checking or checking of these evidences, documents, etc. are going to get happen. Then this year marked a huge leap in case of scrutiny assessment under section 143(2) also. If you see, if you compare with last year's number of scrutiny cases, it has literally 400% higher than that of previous year's statistics. So it's quite evident that department is going to verify all those documents. It was in physical assessment era, maybe 15, 20 years back. All those returns that we are getting submitted are being scrutinized by jurisdictional assessing officers by going through all those back documents, vouchers, basic documents, etc. But those days was, again, after filing into electronic returns, every sort of documents, every sort of vouchers were not required to be uploaded, and only a certain percentage of total files were being selected for scrutiny. This year, not the case. Multifold they have taken for assessment. So while filing these income tax returns, definitely yes, lot of things that we would be required to keep it in mind in order to avoid those selections, in order to avoid high addition in future assessments. So what are all those things that we have to take care while preparing for this tax audit? Definitely, yes, we would be discussing over and above, and we are at the verge wherein we are going to get I would be calling transitional stage from Income Tax Act 1961 to this Income Tax Bill 2025. This Income Tax Bill 2025 is going to get passed by the bill is going to get passed and going to get roll on as an act in this monsoon season. The Parliament will be getting enacted. So definitely it is going to get applicable from first day of April 2026 also tax year concept. So in that context also, all these things definitely yes do have got a lot of things to be done. You have to get prepared for all these sorts of tax filing, especially tax audit cases, company filing, etc. Lot of things we should be also get with for preparation part. So in this context, with this brief introduction, let me on to the topic for the day: professional insight tax audit 24-25. And when and where required, definitely yes, you may ask your queries in that question and answer box. At the end of session, last 10-15 minutes would be definitely devoted for those questions. With this prelude, let me on to that PowerPoint presentation: professional insight tax audit financial year 24-25. So basically, these 4 points that we are going to discuss. The legislation part, we know Income Tax Act section 44AB along with Rule 3G deals with this tax audit provision, and who are all the persons who are required to get audited under this 44AB we would be discussing. Even though it's a preliminary basic provision, everybody may be knowing, but anyhow, for basic brushing up purposes, for just a recapitulation, I would be making you to go through that basic 44AB, various clauses who are required to get audited, along with that interplay between presumptive taxation section within 44AD, 44ADA, 44AE with that of this 44AB section we would be interrelating, correlating. Then we would be discussing about what are all the points that we have to taken care by while preparing for this tax audit, while submitting the income tax returns, etc. Then over and above, all those relevant clauses up to 44 clauses in 3CA, 3CB along with 3CD we would be discussing. 3CA and 3CB are audit reports. 3CA we know those entities who are required to get audited under any other law other than Income Tax Act, like company law, cooperative society law, etc. would be required to be submitted under this 3CA. Other entities have to submit this audit form under audit report form under 3CB. This 3CD have got this many clauses, clause number 1 till clause number 44. So clause by clause, just at a glance, we would be going through what are all those requirements in order to fill those clauses, respective clauses ranging from 1 to 44. Then obviously, yes, the penalty under 271B also we would be discussing for non-furnishing of tax audit reports as well as delay in filing of tax audit reports. Actually, I came across with a situation wherein a separate notice was being initiated. Only at the time of scrutiny assessment, income statement assessment, if not the return was not being followed by a valid tax audit report, or if there was a delay in filing this tax audit report, generally this 271B penalty would have been initiated. But now I came across a situation wherein a standalone notice, the file was not being taken for scrutiny, the file was not taken for income statement assessment, nothing, just for the sake of delay in filing of audit report. We know the audit report has to be submitted 1 month before the due date under section 139(1). So for tax audit assessees, 31st October being the last date, due date for filing it under 139(1) time limit. The time limit in order to upload the tax audit report falls on 30th of September of the relevant assessment year. So in that context, if you have uploaded tax audit report, but it was delayed, maybe a single day delay, maybe 3 month delay, 3 year delay, whatever it is, due to that delay in uploading of this tax audit report, the point was it was being taken for a notice proposing this 271B, but there is a well settled law for this proposition telling that before the file was being selected for scrutiny, if the tax audit has been done and the proper form has been uploaded in 3CA, 3CD or 3CB, 3CD, whatever format it is, then the delay can be condoned. A High Court verdict is there. Despite of all those things, definitely yes, we should keep it in mind every time the High Courts or these judicial forums need not have a pro-assessee view. So in order to get away from all these penalties, etc., definitely yes, we have to make it assured. Timely returns of tax audit reports along with the timely submission of income tax return is a must, and definitely yes, otherwise a single notice for non-furnishing or delay in submission of a tax audit report can fall upon the assessee. So these are all the things that we are going to discuss. So basically, as I mentioned, the legislation part, section 54 AB, prescribes about who are all the firms who are required to get their books of accounts audited by the accountant. Section 44 AB, A clause, talks about business person. So those business persons who are having turnover more than 1 crore could be getting required to audit their books of accounts. But if such business persons are going to get opted for 44 AD, then instead of 1 crore the limit, up to 2 crore and 3 crore, 44 AD option can be opted. In that context, suppose even though their turnover is more than 1 crore, they are going for 44 AD, they are declaring 8% or 6%, then there is no requirement for audit under 44 AB A clause. Otherwise, this 1 crore would be the limit. Then for 44 AD person, the 2 crore has been extended to 3 crore, provided your total receipts and payment 95% and above should be in non-cash form, RTGS, NEFT, IMPBS, etc. Then instead of 2 crore, the limit has been extended to 3 crore for this 44 AD category. So instead of 1 crore, that 2 and 3 crore also has to be read along with. Then another exemption of 10 crore as proviso to this 44 ABA itself provides that if your total turnover is more than 1 crore, then again, if it is less than 10 crore, you are not required to get it audited, provided 95% of your receipts as well as payment are via this non-cash forms, account payee grocery check, RTGS, NEFT, IMPBS. If it is, then even though your turnover is more than 1 crore, 2 crore, 3 crore, if it is up to 10 crore, then there is no requirement to get it audited under section 44 AB A. So this is what the first clause is, 44 AB A for business category of person. Definitely yes, this business has to be segregated with profession. If you are having professional turnover, if you are having business turnover, whether both the turnover has to be clubbed in order to make the turnover to be 1 crore, no, it is not. Business turnover separate, it should be more than 1 crore, 2 crore, 3 crore or 10 crore. Professional receipt should be more than 50 lakh rupees separate. If any one of those conditions are being made applicable, then only this tax audit provision would be there. And supposing you yourself to be a doctor, if you are having professional receipts more than 50 lakh rupees, in that profession itself, over and above the profession, suppose if you are having some other business and total receipt is less than 1 crore. So the question is whether both the accounts has to be audited. Both the professional books of accounts as well as business books of accounts is required to get audited. The answer may be no, maybe yes. Why? Because if the person is having that business into it, he is declaring it under 44 AD, then there is no requirement to make it audited. In that way, even though your professional receipt is more than 50 lakh rupees, we are having a meager turnover business, that books of accounts need not get be audited by that relevant auditor who are doing this. In that context, separate turnover should be there for business as well as for profession. The thing that we have to keep it in mind. Then after A clause and B clause, we know deemed profit under section 44 AE, BB and triple B are there. AE is for flying goods, leasing, etc. BB and BBB for special shipping businesses, etc. So in this context, the presumptive profit as declared under the respective provision, if you are declaring it less than the same, then definitely yes, you would be required to get audited under 44 AB C clause. Same with regarding to 44 ADA presumptive section also. For 44 ADA, if you are as per section 44 AA, and if your turnover is less than 50 lakh rupees, That 50 lakh rupees, just as if 2 crore has been extended to 3 crore for AD. 40 for AD also, 50 lakhs has been extended to 75 lakh rupees, provided the 95% criteria is being satisfied. So if you are having turnover receipts up to 75 lakhs, if you declare, and if you are declaring lesser than 50% of your total receipt, say 40 lakh rupees you are having the total receipt, and 50% 20 lakh rupees you are ought to have been declared as your taxable profit. But if you are declaring only 15 lakh rupees, 5 lakh lower than 20 lakh rupees, then you would be required to get audited under section 44AB D clause. So if you are a professional specified 44AA, your turnover is more than 50 lakh, obviously yes, B clause, you are required to get audited. If it is less than 50 lakh, you are supposed to declare 50% minimum. If you are declaring it lesser than 50%, then definitely yes, you would be required to get audited under D clause. Only one exemption for this D clause is, even though you are declaring your total income less than 50%, taxable income less than 50%, but if the declared income is less than minimum amount not chargeable to tax, MANCP, minimum amount not chargeable to tax, say threshold limit for an individual 2.5 lakh, 3 lakh rupees are the threshold limit. Suppose you are having a turnover of 10 lakh, you are supposed to declare 5 lakh rupees. But if your total income after all these things is say 2 lakh rupees you are declaring, then even though the total amount that you are declared as taxable profit is less than 50%, for the reason your amount of income is less than taxable limit, then you are not required to get the books of accounts audited. But that privilege is not applicable for 50 lakh criteria and above, because already if your turnover is more than 50 lakh, irrespective of your profit or loss, then you would be required to do it under B clause. But for those persons who are having turnover less than 50 lakh, but they are having total income less than threshold limit or even losses, then definitely yes, audit would not be there. Then E clause, quite a relevant clause, 44AD, 4 if you have opted out. So while discussing this E clause, definitely yes, you should know what this 44AD 4 clause is. 44AD prescribes if you want to declare 8%, 6% of the total receipt of total turnover as your profit, then you have to exercise that option for at least 5 more years, including this year. So within this period, that we can term it to be as a lock-in period. So within this lock-in period, suppose you are opting out in the sense, if you want to declare less than 8%, less than 6%, and your income is more than basic tax limit also, then for the next 5 years from the year of opting out, irrespective of your profit, irrespective of your turnover, whatever it is, you would be required to prepare the entire books of accounts under 44AA. Then you have to audit it under section 44AB E clause also. So this point also you would be required to get noted about, for the reason, only if you have opted for 44AD and you have opted out, then only this clause 44AD, 44AB E clause would be applicable. These things again we would be repeating, and that interplay between presumptive taxation provisions with that of tax audit provision we would be discussing later. But for the time being, while going through the legislation itself, you should get that bare idea when the file, when the assessee is required to get it audited under section 44AB. So this many clauses, A to E clauses are there. So A for business category of person, B for professional, C for 44AE, B category, then D for professional, specified professional, 44ADA category, and 44AD for category is E clause. This many things are there. So while calculating this many things, first and foremost thing that we have to understand is what is turnover, what is gross receipt, whether it is inclusive of GST or such sort of indirect taxes, whether other income also would be required to be added along with. Whether fixed asset sale should also form part of turnover. For that sake, the previous guidance note issued by ACAI, we can refer in depth. We cannot discuss the term turnover, but for the time being, let us understand the calculation of turnover. It is X all indirect taxes, not including GST collected, etc. It should be. Then, as far as this other incomes are concerned, definitely yes, it would be forming part, but it is not the aggregate turnover concept under GST. So that sale of fixed assets would not be taken as a turnover here. Then if you are a partner of firm, if you are receiving any remuneration, it is being taxed under the head CGBP. But for that reason, it would not be forming part of your turnover. The partner's remuneration would not be included. Then for those persons who are interacting in derivative contracts, futures, options, speculative business, etc., it is not the total sale value which would be constituting under the term sales or turnover receipts, rather only the differential portion, purchase minus sale, positive or negative, the total modulus without considering negative or positive, the total differential portion between sales value and purchase value would be treated to be as the turnover. So in that way, the total turnover calculation also is quite what you call a complex task, I would call. In that context, you have to calculate that turnover, and on the basis of that turnover, as per this 44AB, you have to calculate and you have to go through all these criteria in order to all these subclauses in order to classify whether it is auditable or not. So this many things as this section 44AB itself you have to taken care by. Then rule 6G I was mentioning talks about this audit report form, and we know this audit report forms 3CD. 3CD is that annexure which the client is supposed to do to fill, and the report after verifying the financial books of accounts as well as the enclosed 3CD, the auditor would be required to verify and how to audit and how to give their opinion in form 3CA or in form 3CB. So the distinction again I would be telling you, 3CA is applicable for those who are required to get audited under any other law. Say if you are a private limited or public limited company, then your books of accounts are required to get audited under a company law provision. So for a company, a statutory auditor would be there. So that statutory auditor's report comparing the same, you are going to give tax audit report. Even though both auditor can be same, both can be different also. In that context, the tax auditor would be giving the report under form 3CA, or in case of a cooperative society, or in case of a limited liability partnership required to get audited. And all those counts, definitely yes, the form should be in 3CA along with the next form 3CD. 3CD, again I would be telling you, is required to be submitted or required to be filled by the assessee. Only the report is going to get issued by the auditor. 3CA for audit cases and any other law, and for any other assessees other than covered under 3CA, maybe a proprietor who is not required to get audited under any other law, a partnership not required to get audited under any other law. For all those entities, the audit report would be in form 3CB. Then already I had mentioned form 3CD. So the main duty of the tax auditor is to verify those figures filled in 3CD ranging from clause number 1 to clause number 44, making it verified whether it is correct or wrong. If any violations, any non-compliances as per those clauses ranging from 1 to 44, while auditing it with financial statements along with various documents, etc., the auditor is required to opine or give an negative opinion, qualified opinion, or a disclaimer of opinion. They would be required to get mentioned in their respective 3CA or 3CB form. So this is how the entire process of tax audit works on this. So these three forms, 3CA or 3CB along with 3CD, are the audit report forms. Then I was mentioning 271B and the recent developments also I was mentioning. So due care has to be taken for submitting these tax audit reports within time limit. There is a myth that tax audit report can be filed before submitting income tax returns. If you are required to submit tax audit without uploading this tax audit, without mentioning the date of uploading, you are submitting income tax returns, then definitely yes, your returns would become defective under section 139. So in that case, you are required to submit tax audit report first, then you would be required to submit this income tax respective return. But the thing that you have to make it ensured is you have to file the tax audit reports on or before 30th of September of relevant assessment year. But for this specific assessment year, definitely yes, there are chances that this due date can be extended. For the basic fundamental reason, the individual returns has been extended up to 15th of September. So there are chances, and the forms are yet to get notified. The 3CD, 3CB applicable for the current year along with ITR 567 yet to get notified. We don't know whether any changes or any critical changes would be there in the respective forms or not. We don't know. For the time being, for this discussion also, I have borrowed it from the last assessment year 24-25 itself. So the time limits that I was mentioning, there are chances that it can also be extended, but we don't know. The Finance Ministry, the North Block, have to declare the same. So the point that we have to make it ensured is you have to upload it, whatever due date it is, on or before the due date. Otherwise, this 271B, half percentage of total turnover or 1.5 lakh. At maximum 1.5 lakh or half percentage of this turnover would be applicable. So that penalty up to 1.5 lakh can be there. So make it assured all these things are being filed properly within the due date. Due dates already I was mentioning. Belated returns up to 31st of December along with the revision of returns. So these are the due dates. If not, it has been extended as if for non-taxable year. Then I was mentioning 44AB, A and B business case, sales or turnover or gross receipts if it is more than 1 crore or 10 crore. The distinction between 1 and 10 crore I was already mentioned. Then in case of profession, gross receipts more than 50 lakh, B clause would be applicable. Then I was mentioning you should not club this business turnover with that of professional turnover for deciding this 50 lakh criteria or this 1 or 10 crore criteria. C clause for the respective AE, BB and BBB, if you are declaring lower than the same, then tax audit would be applicable. ADA also we was mentioning 50 crore, 50%. Then I was mentioning if you are declaring more than 50%, then your total income is less than minimum amount chargeable for tax. Then again tax audit would not be there. But if it is more than the same, you are declaring it less than 50%. Your turnover is less than 50 lakh. Then again you would be required to get it audited. Then E clause also I was mentioning with regarding to that 44AD, but only if it is 44AD 4 clause, then only this thing would be applicable. Say for example, if a person has not opted for 44AD at all, then even though their turnover is, if his turnover is lesser than 1 crore rupees and if he is declaring profit less than 8% or 6%, then again he would not be, or that person would not be required to get it audited for the reason 44AD 4 clause is not applicable. Only if you have opted and you are opting it out within 5 years. Only in that situation, this E clause would be applicable. If you have not at all opted for 44AD, if your turnover is less than 1 crore, then there is no requirement to get it audited under 44AB E clause. So this thing actually you would be required to get taken care of. Then all these things, 2 crore, 3 crore, everything I was mentioning. This is the overall picture of threshold limit. Below 1 crore rupees, there is no requirement for audit. But if you have opted in for 44AD and you are opted out for 44AD4, then even though your turnover is less than 1 crore, you would be required to get audited for the next 5 years. Then if it is between 1 to 2 crore or 3 crore, if you have opted for 44AD, no requirement. But if you have not opted for 44AD, then more than 1 crore, you would be required to get it audited. But if your turnover is even more than 1 crore, for 2 crore, 3 crore, up to 10 crore rupees with that proviso, 95% criteria, then even though up to 10 crore turnover, you would not be required to get it audited. Then over and above 10 crore, no other exemptions are there. If your turnover is more than 10 crore, definitely yes, you would be required to get it audited under section 44AB. Then the turnover finding criteria also I was in brief mentioning. So kindly do refer the guidance note to get a better clarity on that term, turnover, gross receipts, etc. 95% criteria I was mentioning. For calculating that 95% is this thing, both revenue as well as capital also is required to get calculated. But for calculating turnover for eligibility for 44AB, then capital receipts would not be counted. So in that context, the term turnover receipts, situation to situation is going to get changed. Here, capital receipts for computing 95%, capital receipts also would be required to get included. So fixed asset register also you would be required to refer for computing this 95% criteria. Then it's regarding to the interplay between this presumptive section 44AD, ADA with that of 44AD. The first and foremost situation, Mr. A started manufacturing and first year's turnover 1 crore 50 lakhs. They are declaring net profit 8 lakhs, which is less than 8%. For the reason it's all cash. If it is non-cash, then only 6% criteria would be there. So for 1.50 lakhs or 1.50 crore, minimum profit they would be required to declare would have been 12 lakh rupees, but they are declaring it only at 8 lakh rupees. So definitely yes, 44AD would not be applicable, and their total income is not lower than basic exemption limit also, which is 2.5 lakh for old regime, 3 lakh for new regime. So in that case, 44AD would not be applicable, but 44AB would be applicable for the reason the turnover is more than 1 crore. Even though it is less than 2 crore, for the reason 44AD is not there, then 44AB A clause would be applicable and 44AB audit would be there. First situation. Second illustration, B trading and have a turnover in form of all cash 90 lakhs rupees, which is less than 1 crore. Total net profit from that business is 10 lakh rupees. He's a doctor also, or she is a doctor also, and from that profession she is getting 45 lakh turnover. From that profession she is having a net profit of 25 lakh and having a total income of 32 lakh, including this business as well as profession. So the question is whether 44AD is applicable in this case, 44ADA is applicable, 44AB is applicable. This many particulars have been given. So fundamentally, first question, whether 44AD is applicable, we can say. Fundamentally speaking, for 44AD, if you are going to adopt, you are going to opt with, then definitely yes, certain restrictions are there. What are all those restrictions? First of all, if you are having any income, or if you are a specified professional under 44AA, then 44AB is not applicable. So first, ineligibility. Then if you are an commission income person, if you are having any income in form of commission brokerage, then again 44AD would not be applicable. Then if you are having agency business, then again you are ineligible to participate with 44AD. Plus other restrictions are also there. So if we combinedly read this restriction, here in this instant case, this person is a doctor, medical practitioner. So in that context, definitely yes, she is a specified professional as under section 44AA. Due to that reason, she cannot opt for 44AD, even though she is declaring it more than 8%, 6%, etc. Point number 1. So 44 AD is not applicable for the reason she is a specified professional under 44 AA. Then whether 44 ADA is applicable. So whether the similar provision is there under 44 ADA, whether 44 ADA there is a restriction wherein if you are having business receipt, then you cannot go for 44 ADA. No such restrictions are there under 44 ADA. So if you are declaring it more than 50%, then definitely yes, you can go for the same. So total doctor fee is 45 lakh. So minimum 22.5 lakh they are required to declare. She is declaring it at more than 50%, 25 lakh. So definitely yes, 44 ADA can be made applicable. Now the third question. So second question, 44 ADA, it can be opted. Third question, whether tax audit is applicable under section 44 AD. So you may be having that misconception. I was mentioning in the previous provisions itself. 90 lakh plus 45 lakh total receipt is 1.35 crores, which is more than 1 crore rupees. Then 44 AB A clause is applicable. The answer is wrong, because I was mentioning business turnover separately more than 1 crore, then only A clause would be applicable. Professional receipts more than 50 lakh separate, then only 44 AB B clause would be applicable. In that context, both 50 lakh criteria, 1 crore criteria is not been separately not achieved. Thereby, there is no tax audit under section 44 AB. So 44 AD, no, by virtue of she is a professional. 44 ADA, yes, she is declaring more than 50%. 44 AB, no, both the A clause and B clause are not being satisfied. Second illustration over. Now comes third illustration. See, first year turnover 80 lakh rupees, net profit 4 lakh, total income 3 lakh. In that context, whether 44 AD would be applicable, whether 44 AB would be applicable. Two questions we would be required to get answered. In that context, 80%, 8%, it's all in cash. So 8% you would be required to declare. 80 lakh multiplied by 8%, 6.4 lakh is the minimum net profit you would be required to declare. But here the total profit that she is declaring is only 4 lakh rupees. So 6.4 lakh rupees minimum she is not declaring. And the total income is more than basic limit also. So whether 44 AB would be applicable is the next question. So before which, whether 44 AD is applicable, the answer is no, because she is not declaring it at a minimal percentage as prescribed under section 44 AD. So now the question is, for the reason she is not declaring the profit minimum percentage as prescribed under section 144 AD. So in that case, whether 44 AB would be applicable is the question. There I was mentioning, just for the reason that the total profit declared is less than 8%, less than 6%, it would come under 44 AB E clause. Only wherein if we have or she have opted for 44 AD and had opted out by declaring a lower profit in within 5 years from the year of opting in under 44 AD. Only if she is opting out under 44 AD foreclose, then only this 44 AB E clause would be applicable. Here it is specifically mentioned that it is first year. So you have to presume in any one of the previous years, they have not declared it under 44 AD. This is the first year. So here, even though they are declaring it lesser than the specified limit, they need not get it audited, but they cannot file ITR 4. They would be required to file ITR 3, proper balance sheet, proper profit and loss account. You would be required to upload. In that context, you are not required to audit it under section 44 AB. So two answers: 44 AD no, because lesser than 8%. 44 AB also no, because 44 AB E clause would not be applicable for the reason 44 AD 4 opting out is also not there. Fourth illustration, D, a trader, turnover 95 lakh, business turnover 95 lakh, having a commission income 6 lakh rupees, declaring net profit 15 lakh, after deduction total income 14 lakh. So net profit declared more than 8%, definitely yes. So whether 44 AD can be opted? The answer is big no. Even though you are declaring it more than 8%, for the reason you are having commission income. I was mentioning you should not have income from specified profession. You should not have income from commission or brokerage. You should not be doing agency business. Then only you can declare it under 44 AD. I was mentioning. So due to that reason, she is having or he is having income under commission head. Then you are not allowed to opt for 44 AD. So P&L account balance sheet you have to upload. So the next thing is whether 44 AB is applicable in this instant example. You may be having a feeling only turnover is 95 lakhs, but the answer is no. You would be required to get it audited for the reason commission income also would be forming part of turnover for business. It is not a professional turnover. So that 6 lakh along with the 95 lakh, it would be more than 1 crore rupees. So definitely yes, 44 AB A clause would be applicable. If you are not opting for 44 AD, if your turnover is more than 1 crore rupees, you would be required to get the books of accounts audited under section 44 AB A clause. So for the final illustration, 44 AD no, 44 AB yes. So this many illustrations. For the paucity of time, I was just going through these fundamental provisions. But any doubts that you feel, definitely yes, you can give it in question and answer box. At the end of the session, we would be discussing all those separate questions. So after this illustration, after this interplay between this 44 AB with that of 44 AD, ADA and AE, now what are all the things that we would be required to taken care? First and foremost thing, you have to ensure the opening balances are proper. All those amounts which were as closing figures for the last financial year, you have to make it assured all the closing figures are put or carry forward as opening figures or not. Especially you have to make it assured the fixed asset balance as per the last ITR with that of your books of accounts, the same amount within your books also. But in case of companies, for the obvious reason, depreciation rate as per schedule number 2 to Companies Act 2013 would be different from that of section 32 depreciation rate of Income Tax Act. So you have to make it assured the correlation is there. Then suppose there is a case wherein say 44 ABE case itself, till last year the books of accounts was not been audited. From this year you would be required to make it audited. So in that case, how to get this opening balance of fixed assets? So right from the year of purchase, 44 AD, if you are declaring it at 8%, all the expenses are deemed to have been allowed. So all those admissible expenses include depreciation under section 32 also. So by virtue of that section, every year it is perceived that that amount of depreciation has been deducted. So the net written down value after deducting, even though it was not explicitly claimed while filing the income tax returns, while filing ITR 4, even though you have not shown it separately, but you have to presume it has been deducted, and only the residue after deducting all those amounts you have to make it as opening figure for the current tax auditing year. And again, for this persons who are having higher turnovers, last year the turnover was beneath the limit, this year beyond the limit, then also the depreciation net figure only you are required to carry forward. In that context, all those figures, reported figures, tax year figures, you compare it with previous year income tax return ITR 3, all those ITR form, The same with books of accounts, make it assured it is been there in the opening balance also. Because if there is any variance between the previous closing with that of this year opening, definitely yes, it would hit risk management strategy, RMS criteria, and your file is having more probability to get it for scrutiny or for income statement assessment. So make it assured this minimal requirement, the closing figure of the previous year should be the opening figure for the relevant year also. So that opening balance verification you would be required to do. Last year's closing balance of assets and liability are incorporated as opening balance of this year. Assure that there is no difference in closing and opening balance of any account. Verify that opening balance is entered correctly. Then the next thing is, especially in case of partnerships and proprietorship business, there are chances that various personal expenses also would be routed through the firm's books of accounts, firm's bank account, etc. So by oversight, there are very chances while posting those bank entries and all, those personal expenses can be booked as this tax-free or this allowable deductible expenses. So make it ensured those personal expenses are not being taken as business expenses. It should be treated as drawings only. So proper accounting entry has been passed for drawings, not as this business expenses. You would be required to ensure. Then definitely yes, you have to make it assured the name, PAN, address, proper address are being given, and make it assured this proper address is as per the GST records, tallying with it is a company MTA, ROC records, registrar of firms records. In that context, if there is any change in address during the period, those particulars also you would be required to ask. Then there are chances in case of any mistakes in PAN number also can be changed. In that context, any changes in PAN, you have to make it ensure during the period. So you are not supposed to copy and paste. If you are a regular client, previous year report, previous year name, previous year PAN, previous year address, you are not supposed to do copy and paste. Make it assured if there are any changes in this basic particulars even. Then within which you have to make it ensured, quite a relevant point, email ID and mobile number in portal, and the email ID and mobile number that you are going to give in the return is of the organization itself. It's a proprietor, make it assured proprietor's mobile number and email ID, official email ID, personal email ID has been updated in portal as well as in income tax returns. In case wherein the consultant or consultant firms, advisors firms, staffs, email ID, mobile number, there is a habit. For the reason OTPs would be generated to these email ID and mobile numbers. To get it easily, there are chances that we are having this issue of miscommunications or non-communications. If any notices are issued, if any correspondences from income tax departments are issued in this email ID or mobile numbers, there are chances that it can be overlooked, which would turn down or which would turn up the chances for best judgment assessment under 144, which definitely yes could be a high pitched assessment. So in order to avoid those non-communication, make it assured the email ID, mobile number in the return and in the portal are proper, are not outdated also. Now, with regarding to GST registrations, customs registrations, etc., those registration details also we would be required to collect. Suppose in the previous year they may be having trading or that business in one state only, so one GST number would be there. But next year, supposing they have enlarged or have widened their business to some other state, then make it assured the GST number of that state also is being collected, without which all those states can be declared to be as unexplained sort of receipt. So to avoid all these wild sort of guesses or assessments from the department, make it assured all those correct particulars are being given. Then nature of business also you would be required to given properly. Because you yourself to be as a manufacturer and yourself to be as a trader for a same commodity is going to fetch different rates of profit, different sort of ratios, etc. So the department would be having those benchmarked ratios. Supposing you are having a turnover of 1 crore rupees, if you are a manufacturer, the department would be expecting, say, 5% to be minimum profit. But if you are a trader, the department may be expecting only 2% as profit. So if you are a trader, mistakenly you have selected as a manufacturer. So this criteria, the department, the website, database would be checking these criteria automatically. So wrong selection of this business would have higher probability to get for this scrutiny assessment, etc. Then if there is a change in business, that also you would be required to give it. In that context, selection of business, if you are a retailer, wholesaler, again, the benchmark ratio would change. If you are a service provider, then again, it would change. In that context, you would be required to declare the nature of business properly. Then I was mentioning, with regarding to the retail of partner, director, any changes within the same. Then the voting powers of the same, because if you are submitting it for an AOP BOI, if that share of profit is not determinable, automatically the maximum marginal rate of taxes would be applicable for them. In order to get away from those stringent situations, those particulars you would be required to properly do. Profit sharing ratio also you would be required to change. Nowadays, the department do intercheck the profits or the share of remuneration given for the partners with that of remuneration declared by the partners in their personal return. So all these particulars you would be required to give properly without any errors, issues. Otherwise, definitely yes, there are more probability for further notice. Then, with regarding to this taxation and accounting policies, even though you are in a tax audit case, I was mentioning, any other sort of business, any presumptive business if you are having, that also you can declare. Then nowadays, there are varieties of options for paying tax. For individuals, 115 BAT is there, cooperative society, BAD is there. For companies, BA, BAA, BAB is there. So in that context, various options, new option, old options are there. You have to make it assured while shifting from one to another. If you are not going for default, if you are going for another one, proper form in 10IEA, etc. has been filed. You have to make it assured. So in that context, you would be required to make it assured whether the proper forms has been filed to select these varieties of options under Income Tax Act. Then, first of all, you would be required to check the income tax site particulars. You know, it is not only confined to tax audit cases, but also applicable to non-tax audit filers also. Go through your annual information statement, AAS, TAS, 26AS, reporting portal. Try to collect all the information and make it assured. All the figures in that website are in your books of accounts also, in your income tax returns also. Without which, if there is any mismatch between the income declared and those particulars in AAS, TAS, etc., then definitely yes, your risk management strategy would get invoked. There are good chances that your file would be taken for verification. So in that context, you have to go through this 26AS, AAS, etc. But due to some special situations, the figures appearing in 26AS need not get matched with that of actual this year's figures. Say for example, if you are a works contractor, then section 194C, the deductor would have deducted the TDS at the time of credit or at the time of payment, whichever is earlier. So at the time of advance also they would have deducted that EV. But as a contractor, suppose you are accounting it on an accrual basis of system. Or as per accounting standard number 7, construction contract, revenue recognition, separate standard is there. So due to that accrual concept or recognition of income as per AS2, there are very good chance that the difference between 26 AS figures with that of your books of accounts figure may be there. Then in case of GST also, GST turnover is determined on the basis of time of supply. So there can be also variance with that of time of supply with that of revenue recognition principle. So these three figures may vary. Your GST turnover may vary from books of accounts, income tax turnover with that of 26 days reflecting turnover. So you should have that reconciliation statement in hand. For the reason that your 26 days turnover differ from your books of accounts, no need to get worried, but you should be having that handy reconciliation. When and where required, you notices any further correspondences, you should be ready in order to give the clarification. In that context, you have to verify and make it assured. Or in case any difference, you should have that valid reconciliation in your hand to satisfy the departmental query. So this accounting standard as well as this ICDS also, while valuing stock, while valuing this construction contract sort of a thing, while determining this contingent liabilities, etc. Income computation disclosure standard is also there. So all those things also you would be required to verify, and any non-compliances with regarding to this ICDS also you would be required to report in your 3CD report. So in this context, the taxation and accounting policies you would be required to verify with. Then 44AA, we know the section which prescribes what are all the books of accounts that you are required to mandatorily maintain, read along with rule 6F. In that context, whether all those mandatory books of accounts are being maintained, all the registers are being maintained, that thing you would be required to verify. What are all the books of accounts maintained? What are all the books of accounts verified, audited? Those particulars you would be required to give. Then the second point already I have mentioned, you should have that reconciliation statement. If any difference between 26 AS reflecting figures with that of this turnover or those receipts as you have declared in your profitability statement. Then specifically, yes, you should have thorough knowledge with regarding to those allowable expenditure. Section 30 to 37 talks about which are all those expenses which are allowable, and section 40 series talks about various disallowances due to cash payment, disallowances due to payment to related parties, disallowances due to not actual payment under 43B, etc. So all those allowances, all those disallowances, and certain cases certain deemed income under section 41 also, all those things you would be required to verify. Then we know while making this statutory payment, may it be labor related EPF, ESI, next month 15th, you are supposed to make the employer as well as employees contribution. But if you have collected and if you have not paid the employees contribution within this so-called 15th of next month under the relevant labor law, then the collected amount, even though you have paid it after the due date, the collected amount would be treated as income, and the remitted amount would not be treated as expenses. It would be treated to be as your income for the relevant year. So all those things you have to keep it in mind, and those addition of income you should keep it in mind while calculating this taxable profit with that of book profit after all these disallowances. So all those allowances, disallowances, section 30 to 38 allowances, 40 series disallowances, 41 deemed income, and this statutory payment. Then 43B also insists certain types of payments are allowable only if it is being paid within due date under section 139 and 1, except this 43BH. 2 years before only that section was inserted, wherein if you are having any purchases from an MSME unit, there too, if you have not made the payment within 15 or 45 days as per the tax, if it is outstanding as on 31st of March of the relevant previous year, then the entire amount would be added as an income. So that time limit that the payment has to be made is not 139 one time limit, only for this 43BH. Apart from any other 43B items, you have to make it before the end of previous year last day, 31st of March. In that context, there are certain expenses which would be allowed as expenses only on actual payment, 43B. So scratch the same. So all those things, all those relevant allowances, relevant disallowances, you would be required to check with. Then deductions also, may it be 80 C to 80U deduction, Chapter 6A deductions, or maybe any other specific sort of exemptions, etc. claim. All those proofs, all those documents, before filing, you have to ensure it is there. Without which, definitely yes, at the time of scrutiny, it may prove to be costly. In that context, while booking all those deductions, you have to make it assured all these things are there. Then, while going through the balance sheet, make it assured if there are any capital addition, sourceable sources are there, or those trackable sources are there, solid sources are there. Otherwise, it would turn out to unexplained investments. Then any loans received or loans paid back or advance granted, make it assured 269SS, 269T, 269SS at the time of giving loan, it should not be more than 20,000 to a single person during the year outstanding in non-cash form. So cash loans are prohibited, and cash loan repayment are also prohibited. 100% equal penalty would be there. Then a ceiling limit for no payment, you can make it under 269 ST, 2 lakh rupees or more. It should not be there. Maybe a capital transaction, revenue transaction, or respective. So those restrictions are also there. You have to make it assured no such transactions are there in the books of accounts. Then, with relating to 40A3 along with Rule 6DD, cash payments, revenue expenditure more than 10,000 if there are, you have to separately report. Then expenses only on the basis of actual payment, 43B I was mentioning, that also along with 43BH, you would be required to compute with. So all these counts plus those brought forward depreciation. Then with regarding to that depreciation, with regarding to that brought forward losses, etc. If you are going for new tax regime options, then there are restrictions for additional depreciation for specific sort of expenses, etc. So make it assured that carry forward losses or carry forward depreciation doesn't comprise of those ineligible sort of deductions if you are going for new regime, etc. In this context, all these things are the important points that you have to keep it in mind before filling this 3CD form. Now, as last part of our discussion for the next 15-20 minutes, I would be making you to go through these close by close reports of 3CD. So I was mentioning 3CD, the correct reporting part as far as this tax audit is concerned. 3CD, literally the assessee, the client is required to fill, and the auditor is required to compare or verify the 3CD particulars with that of actual financials and documents and vouchers, and how to opine, give their opinion in respective audit report form under 3CA or 3CB. In this context, even though it is client-based reform, sometimes auditor may be also filling on behalf of the client. Anyhow, as a practitioner, as a advisor, as a client, as a CFO, as a finance manager, accounts manager of a company, we also may be required to fill this 3CB particulars. So close by close, 1 to 44 clauses are there. Due to paucity of time, I am not indulging onto each and very close specifically, or in-depth analysis is not possible. So in a shorter way, in a nutshell, I'm going to discuss each and every clause, right from 1 to 44. So first and foremost, the name of assessee is the first clause. There are also the name of proprietor, the name of this thing that should match with PAN, that you have to make it assured. If there is any change in name, that also has to be taken care of. So clause number 1, name. Even though simple, small mistakes may prove to be costly, the name you have to enter properly. Then address I was mentioning, you have to make it assured. The address is properly given. Any change in address, any branch addresses, any change in corporate addresses, all those things, you have to ensure the proper things are being given. There should not be any mismatch in case of a company. MCA recorded annual report address with that of income tax return address. And you have to give. Then indirect taxes, this thing, GST sort of things, registration numbers, etc. you would be required to give. IE code, etc. you would be required to give. So all those registration numbers you would be required to give under clause number 4. Then clause number 5 with regarding to this residential income tax status, firms include LLP. If there is any change in status, you would be required to give, not residential status, you would be required to give. In that context, what you are, that thing you would be required to give as status. Then previous year assessment here, automatically it would be popped up, no confusion in that previous year assessment year. So 7 clauses over. After this basic part A, now on to part B, ranging from 8 to 44. The 8th clause, as I was mentioning, which clause under 44 AB, you would be getting it audited. But the first part of discussion itself, we were mentioning there are 5 clauses ranging from 44 AB A to 44 AB E. That thing you would be required to give. Then I was mentioning, if you are required to get audited under any other law, then third proviso to 44 AB would be applicable. In such cases, 3CA would be applicable, not 3CB I was mentioning. Those things you would be required to give. And in that clause itself, if you have opted for alternate regimes, those things you would be required to give in this clause, clause number 8. Then comes clause number 9, the name and profit sharing ratio of partners in the firm, limited liability partnership. In case of AOP, BOI, they are particulars. So for that sake, you have to check the partnership agreement, the latest any amendments. You have to check who are all working partners, non-working partners. So make it assured. If they are non-working partners, 40B, remunerations are not allowable. Then if they are partners in remuneration given, the new 194T, TDS reduction has been properly made. Then for a partnership, it is mandatory to get registered under a partnership act, register of firms, etc. So make it assured whether all these things have been done. So those partnership related AOP BOI. Then AOP BOI already I was mentioning, you have to ensure no partners or no members in the firm in that association is having income more than basic limit, and all the share of profit is determinable. Then only the normal slab rates would be applicable. Otherwise, maximum marginal rate would be applicable in those cases. So make it assured what type of AOP BOI it is, whether it is under MMR or under slab rate. For all those things, you should have that bylaw, that partnership deed, that basic charter of such entities. Make it assured it is your latest one. Then for nature of business or profession, you would be required to give what is nature of business. Already I have mentioned the business codes are there. Wrong codes, retail instead of wholesale, manufacturing instead of trade, service instead of goods. All those things would prove costly. So make it assured the nature of business is been properly given. Multi-business also, you can give more than a single option. So main code connection would be there. Make it assured that the correct code has been selected. Then under clause 11, what are all the books of accounts you have maintained, and what are all the books of accounts you have verified, not verified. That checklist also you would be required to give. That 44 AA along with rule 6F talks about the books of accounts that you have to maintain. So those things you would be required to give. But that 44 AA is not applicable for companies. But there are chances wherein the companies are also being selected with 44 AA, which is a wrong this thing. Then where these books of accounts are being maintained, the address should be reported. So if it is not in a registered office, you have to ensure where it is being recorded, whether it is being maintained, it's been informed with income tax officers. Then whether it is been verified for audit also is required to give. The things which are being given in red mark are those instances wherein all those things were not being taken care of. So those things you have to put more care about. Then presumptive profit clause 12, I was mentioning, even though one part of your total income is covered for tax audit, there can be various other streams wherein tax audit is not applicable. There you can opt for a presumptive taxation provision. So those things, if you are going for presumptive taxation, that is not the responsibility of auditor to take care of those accounts. So those particulars also you would be required to give in clause number 12. Then clause number 13, the accounting methodology. What type of this thing, if you are maintaining the books of accounts as per section 145, you make it assured. Any variances with 145A, stock valuation, etc., you would be required to report. Any non-compliances with this ICDS, Income Computation Disclosure Standard, also you would be required to give. That increase or decrease in profit due to this non-compliances, you should be required to give in that column. If it is not possible to do it, disclaimer also is required to get mentioned. So in this way, clause number 13, you would be required to fill. Then regarding this closing stock 145A, inclusive method of valuation, we know all those GST elements would be included. Then there are critical changes between AS2 valuation with that of ICDS2 valuation. So that valuation method for each category of inventory also is required to report it. Nowadays, for scrutiny cases, stock valuation, etc., 142(2)A recently amended. Cost accountants are having that option to verify the inventory if required at the time of assessment by assessing authority. So you have to make it assured the stocks, everything are being valued, are being reported properly. Otherwise, you have to make it reported in this clause number 14. Clause number 15, in case of conversion of capital asset into stock in trade, then that details with regarding to description of asset, date of acquisition, etc., you would be required to give. Then amounts not credited to P&L account, certain incomes, maybe in books of accounts. Say if you see this 26 AS 194R recently inserted section, lot of incomes in form of various non-cash benefits can be received by the proprietors. For the reason it is not monetary, it is not passing through bank accounts. There are chances that it may be unrecorded, not recorded in proper books of accounts. So in this context, definitely yes, you have to make it assured all those incomes are being recorded with. Then pro forma credits, drawback, refund of customs duty, etc., escalation claims, etc. Then any other income 50C, what you call stamp value more than actual value. Then various subsidies, grants, etc., not credited to P&L account. All these incomes not recorded in P&L account, but if it is a taxable income, you have to declare income tax return, and the same has to be reported in clause 16 also. Then 50C, just as if the transfer of land and building is more than less than the stamp value, those figures you would be required to give, and that clause 17 deals with the same. Then depreciation of fixed assets, I was mentioning. The previous year, this thing you have to make it assured. This year also it has been done. Then 182 days condition you would be required to make it assured. Then ICDS sort of depreciation tactics with that of AS10, this any distinction if it is there. Then this companies related depreciation with that of Schedule 2 depreciation with that of 32 depreciation if the reconciliation is there. Addition, deletion, return off, etc. All these things you would be required to taken care about and how to properly fill that clause number 18. Then if you are having any additional deductions under 32 AC to 35E, separate report you have to get, and on that basis you would be required to claim those deductions. Then I was mentioning contribution, employees contribution, etc. You would be required to take the payment before the due date. Otherwise, it would be the income for the current period, even though you have paid to clause 20. Vigilantly, you would be required to report. Then 21, inadmissible expenses, lot of inadmissible expenses in form of capital expenditure, personal expenditure, advertisement in political parties, any amount paid in violation of law, amendments via the prohibition outside India without deducting TDS, then any amount paid prohibited by law without deducting TDS. Suppose you have paid the payment to resident, non-resident, 40A, 40A, 1A, etc. would hit on you. Then if you have paid more than the limit, 40B direct disallowances are there. So a non-working partner, 40B which is there. Then if you are paid cash more than 10,000, 40A3 would be there. So in that context, various disallowances are there. Then 43B specifically deals with deduction on the basis actual payment only. So those disallowances you would be required to give separately. Then important clause 43BH related, clause 22 I was mentioning. If you have not made the payment within 15 days or 45 days to a registered MSME, so it should be a manufacturer, it should be a service provider. If you are purchasing from a non-manufacturer trader, then these disallowances would not be applicable. Then if they are not registered under MSMED, Udyam registration they have not availed, then also this disallowance would not be there. Apart from which, if it is a medium enterprise in the sense previous year, it's up to previous year, if it is more than 50 crore, the total turnover, more than 10 crore their investment, it would be categorized as a medium enterprise. So this restriction, this disallowance is only from those purchases or availment of services from a medium, what do you call, small or micro entity, not from a medium entity. But from this year, from 1/4/2025, it has been extended to 100 crore from 50 crore. But for the financial year 24-25, it is still 50 crore only. In that context, you have to make it assured any of such amounts are pending, outstanding as on 31st of March 2025 in the books of accounts, then it should be disallowed. 23 is relating to related party payments for which related party register you would be required to take, and you have to verify if it is more than logical amount, that amount you would be required to disallow. Then 26 I was mentioning only on the basis of actual payment. H only 139 one time limit is not there, but for any other this thing 139 one time limit you would be required to make the payment, otherwise it would not be an deductible expenses. You have to make the payment within 139(1) if the provisions or payable is there in the balance sheet. And 29 is regarding the shares. If it is more than fair market value 50,000 gift conditions, you would be required to do it. Fundi borrowings, if you have to declare in 30. If it is a transfer pricing, associated enterprise sort of thing, 30 ABC deals with the same. Then 2 lakh and above, if you have availed or repaid cash loans, etc. ST, chooses double S and T, the entire amount would be the penalty. Those things you would be required to report in clause number 31. 33, deductions under chapter 6A, eligibility you have to verify. Then total TDS, TCS, deducted, paid, etc. summary, you would be required to give here. Deducted by you, collected by you, date of payment, date of current creation, etc. you would be required to report in 34. Then 36A, any deemed dividend, 222E, the one from a closely held company to a shareholder, etc. you would be required to give as 36A. If any cost audit, any excise audit, service tax audit conducted during the period, those things you would be required to declare in 37, 38, 39 column. Then I was mentioning this accounting ratios, GP ratio, NP ratio, current ratio. All these things you have to compare with the previous year figures also. Any gigantic variation, you yourself have to compare. If there are subtle variation between previous years with that of current year, definitely yes, RMS, risk management strategy would hit, you can be selected for scrutiny. So those things, those ratios, you would be required to give. Then 42, if any form 61 declared, no income other than specified income, non-pass cases, etc. Then if you are having any reportable transaction, 15G, 15S, etc., if you have declared those 42 clause, you would be required to do it. Then country by country reporting, if you are having more than a country branch, you are a multinational company, those things you would be required to declare in clause number 43. Then finally, the GST breakup. The total GST figures, you have to bifurcate it to be registered, unregistered. You have to take it the figures of expenditure from P&L account as well as from balance sheet. Non-cash charges like depreciation, you would be required not to give, it's not an expenditure. Then all those things you would be required to get it as a registered, unregistered, composite and others. In that context, you would be required to get with. In that context, the GST related particulars also, just as if you are reconciling your this thing for your annual return 9, GST or 9, etc. Here also, you would be required to give that bifurcation of total expenditure. In this way, the entire clauses ranging from 1 to 44, you would be required to give. So this is the basic things that you have to take care with. So in total, last 1 hour 20 minutes, I was discussing about the legislation. What is this tax audit? Then I was telling you about 6G. What are all the reports that is required to be submitted? CCD by the assessee, CCA or CCB by the auditor opining on this CCD report with their books of accounts perspective. Then I was mentioning you about the critical points that you have to take care before approaching this tax audit process. Then clause by clause, right from clause 1 till 44, all those clauses in the 3CD I was separately discussing. So last 10 minutes, over to you, the learned professional. Any doubts from your part, you may feel free to ask. You may start putting those comments in your question and answer box. I'm ready to give you the answer.
Yes, sir.
Yes, madam. Any questions from them? They can ask. Otherwise, couple of points I would be telling, and I can wind up today's session. Any questions till now?
We will have a look, sir.
Please.
No questions as of now related to the topic, sir. Okay, so one question is, only ITR 1 and ITR 4 has been notified yet. ITR 2 and 3 has not been notified. If notified, where to check?
The point is actually partly correct. Now up to ITR 4 it has been notified. ITR 1, ITR 4, maybe 1 month before it was notified. 1 week before, both 2 and 3 is there in the income tax side. So the thing is, ITR 1 to 4 it is available in the income tax portal to file, but the form applicable for partnership firm AOP BOI in form ITR 5 and for companies are yet to get notified. Everything would be in income tax portal itself. In income tax portal, file return option is there. If you go to that file return option, you can see on the basis of assessee category, automatically, if you are an individual SCF, 1 to 4 would be there. If you are a partnership, ITR 5 would appear. If you are a company, then ITR 6 would appear. If you are a registered trust, ITR 7 would appear. In that context, within website, you have to log in and you have to verify whether such forms are being notified. Till date, I was mentioning ITR 1 to ITR 4 notified, 5 to 7 yet to get notified along with this tax audit reports, 3CA, 3CB and 3CB.
No other questions as of now.
Okay. So can we expect some challenges in V3 uploading portal? Total out of syllabus questions, sir, anyhow, I would be giving you. We can hope that V3 would be better and it would be having both the transparency as well as easiness while filing all those forms, because all the procedure for filling those forms and uploading done and dusted. Due to that space constraints, etc., definitely yes, they have come up with this new procedure for filing ROC forms. So let us hope everything would be proper. Maybe some initial part there can be certain technical glitches. Apart from which, definitely yes, you can expect it would be having a smooth flow. So with one small remark, I would be concluding my today's session. Sir, if CMA can do tax audit, again, $1 million question as far as the cost accountants are concerned. And we were having that expectation in the new income tax bill. The cost accountant fraternity also would be included as accountant to conduct the same. But till now, no such moves from the department. But our institute, represented by the central committee, definitely is behind the ministries or behind the concerned authorities to make it assured. We are also included, at least in this income tax bill 2025. Let us hope for the best, but for the time being, it is not included. But not only with pertaining to that signature sort of thing, only for attestation purposes I was mentioning. This income tax provision, definitely yes, we as whole are having a lot of consultancy opportunity, advisory opportunity, litigation opportunity. All these statutory sort of opportunities, definitely yes, if the threshold limits is being raised by the department, by the government, the limit is being done and dusted, then the professional opportunities is supposed to get reduced. Now in an era wherein every sort of informations are available with the department, the audit sort of opportunities are surely going to get vanished sometime or other. So we should have that value addition sort of services given to the public, to the client, then only we can survive it. So definitely yes, we can welcome this income tax bill. We can have a thorough knowledge. We can be the eminent tax professional, and we can give those litigations, we can give those advisory, we can give those better consultancy services. That's how we have to improve our profession, I personally feel. Then, can you explain careful about 194T? Sir, 194T already I was mentioning, Karthik sir. In that context, I was mentioning you with regarding to that provision, this 194T is applicable only from this year, 1/4/2025. So for the financial year 24-25, this 194T, TDS on partner remuneration, interest, etc. is not there. So this tax year audit report is not applicable, first thing. But as you asked, I would be giving what this 194T is, even though you know. 194T, if you are giving remuneration, interest, etc. to a working partner, then you are required to deduct the TDS at the rate of 10% if the total amount is more than 20,000 rupees. Without which, definitely yes, all the non-compliances for TDS would be there. So the deduction point is point of payment or point of due, whichever is earlier. So you have to make it assured if it has been paid during the current month, you have to make it assured the amount has been deducted, and then the 7th of next month you are making the payment. But the point that you have to make it assured is if you are making the payment to working or non-working partner, this 194T would be applicable. But if you are giving that to a non-working partner, definitely yes, it is not eligible for 40B deduction. So partnership deed along with these things you would be making, you have to keep it assured. That's the point. Then again, for literally speaking, it's quite difficult to get the remuneration because at the time of finalization, maybe in the month of September, October, you would be knowing how much exactly is the allowable remuneration at the time of finalization. But for the reason, at the time of credit or payment, whichever is earlier, March month you are required to give a provision. Then after the actual figure, the differential portion, you can create a challan at the end, after which you can create a challan, you can revise what? The quarter 4 returns also. In this way, you have to tackle this section 194T.
Yes, sir.
Any other queries, madam?
No, sir. No other queries, please.
I do think we can conclude then. 4:30 now.
Okay, sir. Thank you so much for your time, and thank you so much for your knowledgeable deliberation. We look forward to many such webinars from you, sir. Thank you so much.
Thank you, TRD. Thank you,
We are
TRD.
ending the session, sir.